Have you been wondering what the TSP Roth is all about and how you might benefit? I've given dozens of training sessions to various agencies like yours, the Secret Service, the Federal District Courts of New York, HUD, Navy for their civilian employees, and others. And one of the things I've noticed over all this time is that the valuable benefits that the TSP Roth brings is just not being utilized the way I would expect. I'm Bob Davidson from BDA Financial. Today, I'm hoping to go through a quick rundown on the TSP Roth, how it works, and hopefully encourage you to take advantage of it more fully. I do believe this to be a very powerful tax management tool that can benefit you later in life. So let's get started. The TSP is, of course, the federal government's version of a 401k plan. It allows you, the participant, to invest money for retirement through payroll deduction. Automatic contributions come out of your pay, and they're consisting of some of your money and federal and state income taxes. So they reduce the amount of income that you're taxed upon each year. And these contributions will grow tax deferred, but withdrawals are taxed as ordinary income when you take them out in retirement. That means that every penny you take out of the traditional TSP is going to be taxed on a federal and potentially state level. The Roth TSP allows you a different approach. The money comes out post-tax, meaning you do not save on your tax bill in this year or any other year when you contribute to the TSP Roth. However, the contributions and earnings both have the potential to grow income tax free if you take them out after age 59 and a half and the account has been established for at least 5 years. Doing some research on the Roth TSP via the Federal Retirement Thrift Investment Board, I came across this chart some weeks back. This is actually dated October 2021. And we can see back then there were 3.7 million FERS participants with an average balance of about $180,000. And of this 3.7 million, only 781,000 were contributing to the Roth, so approximately 20%. And the Roth balances were only around $22,600, a very small amount that I would like to see grow. For this to be beneficial to you, you really do need more than that. Now, let's clean up some misconceptions on the match. Some folks have always been concerned that if they put money into the Roth, they will miss out on the match. Now, just remember, the first 5% of pay for every pay cycle that we have during the year, and there's typically 26, occasionally 27 pay cycles, the first 5% must go in, right? You put in 5, the agency will match you 5%. If you put in 4, you're not going to get 5. And if you put in 10, you'll still get 5. So 5 is kind of the magic number for simplicity. Now, remember, every pay period, that's a huge, huge deal. Now, if you put money into the Roth, that's fine. You will still get the full 5. It doesn't matter to OPM. It's just the 5%. Now, this year, 2022, you can contribute a maximum of 100% of pay to $20,500. And if you're going to be 50 and older at any point during this year, even December 31, you can use the catch-up provision and add an additional $6,500, provided you do, in fact, put in the full $20,500 as well. So that allows you to save in 2022 $27,000. The number being indexed will go up over the years. Now, we have these 2 criteria to take tax-free distributions out of your account. Simple. The first one is you have to be 59 and a half or older, or permanently disabled or deceased when you take your withdrawals. So it's a very high price to pay to be deceased or fully disabled. So let's focus on just getting to 59 and a half. The second rule is the first dollar that hit that account had to have been 5 years ago. Now, the 5-year rule's pretty confusing and convoluted. So, and I'm going to be really simplifying it, but in this case, what you need to know is when your first dollar hits, regardless of the date, it could be July 1st, it could be December 1st, when it hits the account, the IRS will know that you put money in effectively on January 1 of that year. So the start date is always January 1 of the year your first dollar hits. Your Roth contributions will always come out income tax free since they've already been taxed. However, I'm concerned about getting your earnings out income tax free as well. And to do that, you have to obey those two rules, 59 and a half and older at that distribution point, or disabled or dead, and meet the 5-year holding rule. If you wish to transfer at the end of your federal service, be it for retirement or you've just moved on, you can move the money. You can leave it obviously in the Roth TSP, but you can also transfer it out to a Roth IRA or a subsequent employer's Roth 401k. However, the 5-year rule that you've been operating under will not carry over. So if you go to a new employer's Roth 401k, you'll start a new 5-year clock. All right. Now, you've probably also heard of the 10% early withdrawal penalty tax if you take money out of a retirement plan like your TSP or an IRA prior to 59 and a half. This penalty will not apply to your Roth contributions because they've already been taxed and they are always considered to be a qualified distribution. It's the earnings that I'm concerned about, and you should be too. We want to get those earnings out income tax free as well, and that goes back to those two rules, 59 and a half and older, 5 years since the first dollar hit. To make any kind of withdrawal, or for that matter, virtually anything in the TSP, you have to log into your account at tsp.gov. If you're a married FERS TSP participant and are completing a withdrawal form, you will need to print out that form, take your spouse down to a notary's office, sign in front of the notary, get it stamped, bring that form back to your computer and upload it to tsp.gov. CSRs are exempt from notarization because they are not ERISA employees. Now, the form requires you to fill out separately a section for the traditional TSP and the Roth TSP. So if you're taking money out of the traditional TSP, you have to fill that in. Who's getting the money? Is it you? Fine. Do you want tax holding? How much? If it's not going to you directly, if it's going to another plan or some other place, where is it going? What's the account number? Separately, when you do the Roth piece, do you want money from the Roth? Is it being paid to you? Yes, no. If so, tax withholding on any non-qualified distributions. Or is it going into another firm's an IRA as an example, or a 401k? Where is it going? What's the address? What's the account number? That is important that you get that right. I don't want you to blur those two sections together in some way so that you get blended money ending up in the wrong account and therefore creating a little bit of a tax or a record-keeping mess that's going to be difficult to fix. Now, here's an issue that we have a workaround. It's a very simple fix, but this is one that you face currently. The TSP, both traditional and TSP Roth, are subject to required minimum distributions at certain ages. That's abbreviated as an RMD. If you're born prior to June 30th, 1949, you would have had to begin your required minimum distributions after hitting age 70 and a half. That's largely behind us. This rule was modified a couple of years back. The new rule is if you're born after June 30th, 1949, you will become subject to the required minimum distribution rule at age 72. And I look at that as a problem, but it's a problem with a fix. So here's how I see it. In your retirement, not every year is going to be the same as the year before and the year after. Some years you will find to be expensive, and it could be expensive for a variety of different reasons. You might have high medical bills one year. You might have problems in the house where you have to replace, say, your air conditioning or your heating system, and that's expensive. You might have to buy a new car one or more times during retirement. And the issue with that is if you're withdrawing that extra money out of the TSP traditional, that is going to bump up your income for that year. And it'll have an impact on both the taxation of your Social Security, and it may have an impact on how much you pay for Medicare Part B, C, if you have elected them. Now, some of your federal employee health benefit plans require that you take Medicare B. So we want to be cautious that you do not expose yourself to having to pay excess premiums for your health insurance or excess taxation on your Social Security. And through the Roth, we can deal with that. We can get tax-free income to you with a little bit of adjustment to what you're doing in the TSP. Not a big deal. It's something we can do together. Okay, now this is a confusing topic. It's not probably your area of expertise, I'm sure. If you are working with a CPA for your taxes, you should discuss this with them. If you'd like to talk to us, that's fine too. You see our website here and our phone number at the bottom of this page. But we also have an easy way for you to set up a meeting with us. Since you're on our website, BDAFinancial.com, if you look at any page on that in our website, up at the top right corner, you'll see schedule a meeting. You click on that and select, do you want to have a phone call with us? Would you want to do a Zoom meeting with us? Do you want to come in here in person if you're nearby? Set that up, pick your date, pick your time. As soon as you click submit, we will both be sent an automated email confirming that appointment, and I will contact you when it's appropriate. That's very easy to do. So again, here's our data, bdafinancial.com. Our phone number, you can call directly in, 703-779-7410. I thank you for listening today. I hope you got something out of this. I'd love to hear from you soon. And so have a wonderful retirement and take care. Thank you.